Hi. Economies often experience large movements in asset prices that have significant macroeconomic effects. Given that many of these movements have nothing to do with the macroeconomic factors or, for that matter, underlying fundamentals, they have come to be known as asset bubbles, whether it is bursting or swelling. Typically, these bubbles are unpredictable and generate substantial macroeconomic effects. An asset bubble occurs when the price of an asset such as housing, stock, bonds, equity or commodities rises fastly with no underlying fundamentals and also not supported by the value of the product. It is driven by speculative demand and unsustainable in the long run. The hallmark of a bubble is irrational exuberance and overconfidence, a phenomena that everyone is going behind or buying the same asset. For example, we can see the speculative bubble of the increase in gold prices in 1970s and 80s, and the stock market bubble of 1920s when the prices of shares went up more than the earnings. During a bubble, the investors jack up the prices to such extent which is not real and also which is not sustainable for a long run. At a certain price, the bubble bursts and prices come down to a level which is very close to its fundamental value. The damage that is caused by the bursting of a bubble depends upon the economic sectors involved and to the extent of participation, whether it is widespread or localized participation. For example, the bursting of the equity and real estate bubble in Japan in 89 to 1992, wherein the whole Japanese economy was jeopardized, which led to a prolonged stagnation in the Japanese economy, so long that the 1990s are referred to as the lost decade. In the US, the burst of the dot-com bubble in 2000 and the housing bubble in 2008 led to severe recession. In this video, let us look at the causes, the types and stages of bubble, and some of the biggest examples of asset bubbles in recent history. But before that, please listen to Diego Pereira, what he has to say about asset bubbles.
What are bubbles? What are anti-bubbles? I like to borrow George Soros' definition of a bubble. He talks about bubbles as asset valuations that are artificially high based on beliefs that happen to be misconceptions. So beyond just other metrics, he definitely looks into the actual beliefs and misconceptions behind these bubbles. What I've done is I've generalized the framework and basically looking at misconceptions distort reality, but they not only distort reality by artificially creating higher prices, they can also create artificially low prices.
Bubbles usually start for some good economic reasons. If you see, for example, in the early 2000s, low interest rates and economic growth encouraged people to buy a house. And in 1990s, internet stocks did offer prospective growth for this new business. But what happens is rising prices and rising demand can create a dynamic where positive news motivates people to take more risks and prices rise more than what they should. Some factors that cause bubbles are: the first is the irrational exuberance, that is, strong psychological pressures encourages investors to buy assets ignoring the fundamental value of the asset and believing that the prices will keep rising. This is nothing but speculative bubble, where news of price increases spurs investor enthusiasm from person to person and in the process boosting stories that might justify the price increase and thereby bringing in more and more investors who, despite having the doubt about the real value of the investment, are drawn to it. Then the low interest rates, which makes it easy to borrow money cheaply. which also augments investment spending. As investors cannot receive a good return on their investments at these rates, they move their money into higher yield, higher risk asset classes, thereby increasing the asset prices. Then there is the demand pull inflation. This occurs when buyers' demand for an asset exceeds the available supply of that asset, making the price higher and everyone wanting to make profits. Then comes the herding behavior. This is the normal assumption that the majority of the people can't be wrong. Now, if banks and well-established financial leaders are buying, they assume it must be a good investment. Also, that the decisions based are on short-term basis rather than the long-term. And also, there is another cause, which is because people often judge the state of a market and economy by what has happened in the recent past. People also believe that they can beat the market and get out before the bubble pops. Sometimes bubbles occur as an indirect consequence of monetary policy. For example, the Fed's decision to keep interest rates in the US low encouraged the credit bubble of the 2000s. Excess liquidity can more easily lead to bubbles because people need somewhere to put their money. There are 4 types of bubbles: economic bubbles, commodity bubble, stock market bubble, and credit bubbles. Now, economic bubble or the market bubble is when a particular market sees a rapid increase in price. For example, this could be a housing bubble. A house price bubble may cause rising wealth and confidence, leading to higher consumer spending and economic growth. In turn, the higher economic growth feeds the housing boom. Second is the commodity bubble. When the price of one commodity or several commodities increases in price. For example, we might see a speculative bubble in the price of gold in the 70s and 80s. You can see the chart here. Then the stock market bubble. When the value of stock and shares increase rapidly, prices increase faster than earnings. A stock market bubble is vulnerable to a crash where market traders come to feel the bubble prices are overinflated. And lastly, there is the credit bubbles. This is when a rapid growth in consumer and business credit happens because of higher finance and consumer spending. Economists have identified 5 stages of a bubble, a pattern to its rise and fall that could prevent the unwatchful from getting caught in its misleading clutches. These stages also outline the basic pattern of a bubble. The first is the displacement. A displacement occurs when investors get infatuated by a new pattern, such as an innovative new technology or interest rates that are historically low. A classic example of displacement is the decline in the federal funds rate from 6.5% in July 2000 to 1.2% in June 2003. This resulted in sowing the seeds for the subsequent housing bubble in the US. The second is the boom. In this phase, prices rise slowly at first, following a displacement, but then gain momentum as more and more participants enter the market, setting the stage for the boom. During this phase, the asset in question attracts widespread media coverage. As such, investors and traders get drawn into this with the fear of missing out on what could be a once-in-a-lifetime opportunity, which induces more speculation. Then comes euphoria. During this phase, asset prices skyrocket and valuations reach extreme levels as new valuation measures and metrics are hyped to justify the relentless rise and the greater fool theory, the idea that no matter how prices go, there will always be a market of buyers willing to pay more. For example, at the peak of the Japanese real estate bubble in 1989, land in Tokyo was sold for as much as $139,000 per square feet, more than 350 times the value of Manhattan property. Similarly, at the height of the internet bubble in March 2000, the combined value of all technology stocks on the Nasdaq was higher than the GDP of most nations. The fourth is the profit taking. In this phase, taking note of the warning signs that the bubble is about at its bursting point, investors start selling and taking profits. But estimating the exact time when a bubble is due to collapse can be a difficult exercise because, as economist John Keynes puts it, the markets can stay irrational longer than you can stay solvent. The last is the panic. In the panic stage, asset prices reverse course and descend as rapidly as they had ascended. Investors and speculators, faced with margin calls and plunging values of their holdings, now want to liquidate at any price. As supply overwhelms demand, asset prices slide sharply. For example, global panic in financial markets occurred in October 2008, weeks after Lehman Brothers declared bankruptcy. The S&P 500 dived almost 17% in one single month, its ninth worst monthly performance. In that single month, global equity markets lost a staggering $9.3 trillion in market capitalization. Now let us look at some of the examples of asset bubbles in recent history. The tulip mania, which gripped Holland in the 1630s, is considered one of the earliest recorded example of an irrational asset bubble. The tulip prices soared 20-fold times between November 1636 and February 1637 before diving almost 100% by May 1637. As bubbles typically do, tulip mania consumed a wide across section of the Dutch population, and at its peak, some tulip bulbs commanded prices greater than the price of some houses. The second is the South Sea Bubble. A company was set up to profit from British trade with South America, and this was created by a more complex set of circumstances than tulip mania. The South Sea Company was formed in 1711 and was promised a monopoly by the British government on all trade with the Spanish colonies of South America. Expecting a repeat of the success of the East India Company, which provided England a flourishing trade with India, investors snapped up shares of the South Sea Company. The shares of the company rose rapidly because of tales of unimaginable riches in the South Seas. Present-day South America was spoken of, but with the company failing to make any real profit, share prices collapsed in 1720 and returned to pre-issue levels before collapsing in subsequent months and causing a severe economic crisis. Now let us look at the stock market bubble. The bubble started when the Fed eased credit requirements and lowered interest rates in the second half of 1921 through 1922, hoping to prompt borrowing, increase the money supply, and stimulate the economy. It really worked. Consumers and businesses began taking on more debt than ever. By the middle of the decade, there was an additional $500 million in circulation compared to 5 years earlier. The Fed's easy money policies extended through most of the 1920s, and stock prices soared as a result of the new money flowing into the economy through the banking system. But by 1929, cracks began to appear. The problem was debt had fueled too much of the decade's extravagance. The investors, the general public, and the banks eventually became skeptical that the continuous extension of new credit will not go on forever and began to cut back to protect themselves from the eventual speculative losses and began profit booking anticipating market decline. Massive sell-off happened. People and businesses began withdrawing their money at such a rate that the banks didn't have the available capital to meet the requests. The rapidly worsening situation culminated with the crash of 1929, which witnessed the insolvency of several large banks. The crash touched off the Great Depression, still known as the worst economic crisis in modern American history. Now let's look at the 1990s dot-com bubble. In 1995, the Fed began easing monetary policy in order to support the government bailout of the holders of Mexican bonds in response to the Mexican debt crisis. The new liquid credit that the Fed added to the economy began to flow into the emerging tech sector. As the Fed dropped interest rates starting in 1995, the Nasdaq began to really take off. Netscape launched its IPO and the dot-com bubble began. The Nasdaq Composite Index, home to most of the technology dot-com company stocks, soared from a level of under 500 at the beginning of 1990 to a peak of over 5,000 in March 2000. The index crashed shortly thereafter, diving nearly 80% by October 2002 and triggering a US recession. A Nasdaq sell-off in March 2000 marked the end of the dot-com bubble. The recession that followed was relatively shallow for the broader economy but devastating for the tech industry. California, home to tech-heavy Silicon Valley, saw unemployment rates reach their highest levels in decades. But it was in 2015, more than 15 years after its previous peak, that the index reached a new high. The 2000 US housing bubble. According to a report from the US Bureau of Labor Statistics, US house prices doubled from 1996 to 2000. Majority of that increase occurred from 2002 to 2006. It is believed by some experts that the bursting of the Nasdaq dot-com bubble led US investors to pile into real estate due to the mistaken belief that real estate is a safer asset class. Even as house prices were increasing at a record pace, there were mounting signs of an unsustainable hysteria, rampant mortgage fraud, and houses being bought by subprime borrowers, etc. US housing prices reached its pinnacle in 2006 and then commenced a slide that resulted in an average US house losing 1/3 of its value by 2009. This housing boom and bust and the ripple effects it had on mortgage-backed securities resulted in a global economic contraction that was the biggest since the 1930s depression. And subsequently, the period of the late 2000s came to be known as the Great Recession. Asset bubbles has to be blamed for some of the most devastating recessions that is faced in recent history. The stock market bubble of the 1920s, the dot-com bubble of the 1990s, and the real estate bubble of the 2000s were asset bubbles followed by sharp economic downturns. Asset bubbles are especially devastating for individuals and businesses who invest too late, meaning shortly before the bubble bursts. The inevitable collapse of asset bubbles wipes out net worth of investors and causes exposed businesses to fail, potentially touching off a cascade of debt deflation and financial panic that can spread to other parts of the economy, resulting in a period of higher unemployment and lower production that characterizes a recession. So, what are the key takeaways? First, asset bubbles exist when market prices in some sector increase over time and trade much higher than what the fundamentals would suggest. Second, bubbles are misleading and uncertain, but understanding the 5 stages which they go through can help investors prepare for them. Thirdly, the necessary fuel for bubbles is also provided due to excess supply of money and credit in an economy. Then, it is also believed that bubbles are magnified further because of market psychology and emotions like greed and herding instincts. Lastly, when bubbles eventually pop, they tend to leave economic pain in their wake, including recession or even depression. So, the bottom line is that if you think that the value of an asset does not justify the hysteria, then don't go for it and don't buy it. simply because it is going to give you some profits. Often what happens is the price of such assets goes on up and up for years, and it is tough to identify the asset bubble and when it is going to burst. Instead, one should opt for diversified portfolio of investments with a balanced mix of stock, bonds, commodities, and even real estate, and plan in such a way that you don't get caught up into irrational exuberance and fall prey to asset bubbles. Hope this information has been useful. Thank you for watching and take care.